This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV, it's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Welcome back to The Bull, your personal finance podcast. For those who, like me, are passionate about finance, especially the aspects related to portfolio management research, it's easy to understand how thrilling it was to meet a living legend like Robert Arnott. With degrees in economics, mathematics, and computer science, he's a highly awarded author of over 150 research papers published in financial journals, a former executive at Solomon Brothers and First Quadrant, and the founder of Research Affiliates in 2002. Today, his firm manages over 150 billion through proprietary strategies developed by their extraordinary research team. This episode is designed to be valuable not only today, but even 10 years from now. That's why we have avoided any discussion of short-term political and economic news to focus on the only things that truly matter, the timeless and universal principles that help us become better investors. In the presence of Bob, my words are merely an unnecessary interruption. So, without further ado, I leave you with these words, at once profoundly wise and disarmingly straightforward. Enjoy the episode! Dear Bob, welcome to my podcast, The Bull.
Well, thank you very much. It's a privilege.
Oh, it's a privilege for us to have you here. You're a legend, to say the least, for people like me and us who like to understand what investing is all about in truly complicated times like the ones we are living in now. And to start with, this is a podcast about, to say it shortly, passive investing. And if I had to give financial advice to someone asking me what the most reasonable way to invest our saving is, I'd say invest in market cap weighted ETFs tracking broad indexes of stocks and bonds. Full stop. Somehow, I feel you may consider it suboptimal to invest exclusively in market cap weighted indices. Could you please explain why?
Yeah, market cap weighted indexes are a beautiful way to own the entire market. They're very low cost. They wind up letting you keep most of the return instead of your banker or your asset manager. But they do have drawbacks. And one of the drawbacks is that any stock that's overvalued and destined to underperform is overweighting your portfolio. Any stock that's undervalued and destined to outperform is underweighting your portfolio. So most of your money is in overpriced stocks that will underperform. Now, indexers have heard this criticism for the last 70 years and have a ready reply to that, which isn't, unless you can tell me which stocks are over or undervalued, you haven't said anything useful. And that argument carried the day for a long time. But in fact, it's an incomplete answer. The simple fact is, by tying the weight, the size of your investment, to the price of the stock, you are creating that situation. If you break the link with price, then an overvalued stock might be over or underweight. An undervalued stock might be over or underweight. The errors would cancel. So we invented a concept called fundamental index back in 2004, which instead of weighting companies by their market value, weight them by their economic footprint. How big is their business? You can use sales. So weight companies in proportion to the sales of their business, or profits, or net worth, the book value, or how much does it pay out to its shareholders in dividends and buybacks, or a blend of these measures. We prefer a blend because it smooths the rough edges of any single measure approach.
For those who are listening, the official name of the fundamental index is RAFI, which means Research Affiliates Fundamental Index.
Thank you for that.
Sorry for interrupting you.
No, very, very helpful. Thank you. So if you weight companies according to how big their business is, then growth stocks trading at a premium multiple will be reweighted down. Value stocks that are out of favor will be reweighted up. You're going to get a stark value tilt relative to the market. Why would you want to do that? Well, growth stocks have tailwinds, they have good product, they have good management, but everyone knows that. It's in the price. So the only way a growth stock will help your performance is if it exceeds lofty expectations. Value stocks have headwinds. They have lousy management, lousy products, sluggish growth, but everyone knows that. It's in the price. The price already reflects the bad news. So value stocks will only hurt you if they underperform bleak expectations. So it doesn't hurt you to reweight. What really helps you is that if a stock soars and its fundamentals don't, you're going to be trimming it. If a stock tumbles and its fundamentals don't, you're going to be topping it up. So you're going to be contra-trading against the market's most extravagant bets. And that contra-trading gives you a rebalancing alpha. Jack Trainer wrote a paper in 2005, Why Valuation Indifferent Indexing Works. And what he showed was that if the market price movement includes an error, that is to say the market makes a mistake and pushes the price up too high or down too low, the market will seek to correct those errors. And the very act of the market correcting those errors means that you get a rebalancing alpha. That rebalancing alpha works out to about 2% per year. So with fundamental index, you get a value tilt, which cap weighting doesn't give you, and you get a rebalancing alpha, which cap weighting doesn't give you. And the result is that fundamental index strategies, when you compare them with value indexes, relentlessly outperform the value indexes by an average of about 2% per year. Now, 2% a year compounds very nicely. If you are investing 20 years ahead of retirement, that 2% a year will leave you with on the order of 50 or 60% more retirement income than you would have had otherwise. So that's one of the issues with cap-weighted indexes. A second issue that's equally important is what I call selection bias, which means that if a stock has large market value, it's included in the cap-weighted index. Doesn't matter whether the business is big or small, the market value, if it's big enough, it's included. That's a mistake. That means that every stock that an index adds to the index is going to be an expensive, frothy, popular growth stock, which has to live up to lofty expectations in order just to match the market, let alone beat it. Stocks that are dropped are small market value, but they're not necessarily small companies, which means that they have to underperform bleak expectations in order for it not to hurt you to drop them. So selection bias means you're better off if you either use a total market index that includes everything, or use an index that selects stocks for addition or deletion using some measure other than market value. And that's an idea that we've been introducing the last 2 or 3 years. Research Affiliates Cap-Weighted Index, or RACWI. And no, there aren't any ETFs available for it yet, but there will be. And so that represents another way to gain exposure to the broad market without that selection bias, which drags down the performance by about 50 basis points a year. Doesn't sound like much, but when you're talking about index funds that argue about 1 or 2 basis points, 50 basis point return difference is enormous.
Yeah, totally. It's a lot. It's a very big deal. I have 2 questions here. One more theoretical/philosophical and another one more practical. Let's start with the first one. If I put my efficient market hypothesis hat, I'd say prices are basically right. So, how can we exploit this idea? I know you can do it and you did it in a successful way in your career, but if I believe in the efficient market hypothesis, I have to admit that prices are right. Otherwise, I would be rich, as Fama famously says.
Well, firstly, even the most ardent proponents of efficient markets acknowledge that the markets aren't totally efficient. Ken French likes to say the market is 84% efficient.
84 precisely?
Randomly selected high number.
Okay.
Yeah, a randomly selected relatively high number. But you've got to marvel at the magnitude of some of the inefficiencies. Remember GameStop, which rose 100-fold because called a meme. It's basically a narrative out on the internet from a guy named
Roaring Kitty.
Yeah, Roaring Kitty. It rose 100-fold, and there was no fundamental news, no fundamental reason for it to do so.
Sure.
During the early days of the pandemic, everybody was using Zoom.
Remember.
Which is a competitor to StreamYard, but it's a great system. And people looked around for Zoom stock, and there was another Zoom, and that Zoom made recreational vehicles in Sweden. Both Zooms rose 4-fold in 6 months, quadrupled. One of them because it was revolutionizing communication, video communication, and the other because it had some cool winter sports vehicles and snowmobiles. I mean, what? So if the market is efficient, you got to understand, you got to have an explanation for why a snowmobile maker that happens to have the name Zoom should quadruple just because Zoom Technologies is making teleconferencing easy. So the market isn't efficient, but the market is just efficient enough to make it difficult. There are no easy answers. And as soon as people latch on to an inefficiency and start pouring money into exploiting it, the inefficiency goes away. So that's the real puzzle there.
Because you are very easy arbitrage the way.
Right.
Okay. The second question is, as I was saying before, more practical. For the individual investor, it takes a lot of consistency and patience for such a strategy to play out, because I think in the last 15 years, growth stocks dominated the market, but we all know that value stocks tend to outperform in the long run.
Absolutely.
The question is, how difficult is it to stick with a fundamental strategy when your neighbor who had bought Nvidia made tons of money?
Charlie Munger once said, the markets aren't driven by greed and fear, they're driven by envy and fear.
Definitely.
Envy plays a role in creating fear of missing out. Your next door neighbor bought Nvidia 2 years ago and you didn't, and you're feeling really envious of the profits that they made. The simple fact is that fear and envy do drive markets. The inefficiencies are there, the opportunities are there, but the opportunities are constantly shifting. So when it comes to value versus growth, I wrote a paper in 2001 entitled Reports of Value's Death Have Been Greatly Exaggerated. I began the paper, I've been a lifelong value investor, and value investing, as you say, has been difficult the last 15 years. I began the paper by posing the question, scientific method means you want to challenge your own assumptions. So I went into the research with an altered assumption that value had broken, and I set out to prove to myself that value was broken. And instead, what I found was reinforcement that value has been working just fine. Now, how can I say that when value has underperformed severely? The relative cheapness of value stocks between 2007 and 2020 fell from 1/3 the price of growth stocks. They always traded at a discount. 1/3 sounds cheap, but it's not. That's actually more expensive than usual. Fell from 1/3 to 1/9 as expensive as growth. That means relative to growth, it fell by 2/3. It underperformed by a little over half, meaning from 2007 to 2020, if you were a value investor, you were slightly less than half as wealthy as the growth investor who stuck with growth during those 13 years. So think of it this way. If it underperforms by half, while it's getting cheaper by 2/3, that means the underlying earnings and dividends and so forth of the value portfolio are growing faster than the growth portfolio. So what that means is that growth companies were doing fine, but growth stocks weren't. Growth stocks were doing badly because there was this narrative that with advancing technology, a lot of value companies were going to go by the wayside, and then COVID came along, and it was going to lead to sweeping bankruptcies across the world economy. Well, stimulus prevented the sweeping bankruptcies. But in point of fact, value companies were doing better than growth companies. That is to say, the profits of the Russell Value Index or of the ACWI Value Index were growing faster than the profits of Russell Growth or ACWI Growth. Kind of a shocking result. So basically, we proved that the value factor is working, but that it fell out of favor enough because of a narrative that there would be sweeping bankruptcies. It fell out of favor enough that the stocks underperformed even though the businesses were outperforming. Really a fascinating result. So that research and that paper helped to reinforce to me, hang in there. Value, I think, underperforms severely for two reasons. One is that narrative, that technology narrative. The other was a decade of free money. Central banks around the world were flooding the world economy with free money. If interest rates are below the rate of inflation, that is to say the real cost of money is negative, you're going to use that money for stock buybacks. Why not? For dissipating on all sorts of enterprises, some of which are good ideas and some of which aren't. A lot of the money will be wasted. And what you find is that the growth stocks are the ones that can borrow at those extremely low rates. The value companies, because they're slightly troubled, don't get those deeply discounted rates.
Yeah. In sports, it would be called doping.
Yeah.
A couple of weeks ago, we had Michael Green here, and as you can easily imagine, he talked about the problem with indexing and the kind of distortions that it brings about in the market. Do you think that massive indexing may have an impact on the value effect? Because, at least according to Green and others like him, indexing tends to inflate larger growth stocks prices.
The short answer is absolutely. That's another reason that's driven the wedge in valuation between growth and value. Actually, I'm having a conversation with him, I think tomorrow or the next day, about some joint research that we may be doing.
Oh, that's cool.
Fun stuff. He's brilliant. He's just delightful.
Totally.
But yes, if you have money pouring into index funds, it'll push up the price of members of the index and push down the price of non-members, because every time $1 million flows into an index fund, that's $1 million new money to be invested in the stocks in the index fund and to be siphoned out of stocks that aren't in the index. So what we find is that 30 years ago, the spread in valuation between members of the index and non-members was relatively tight, 10 or 20%. And the reason there was a spread at all is that stocks get added because they're popular and large market cap, which means it's the selection bias problem. You're adding stocks that are frothy and beloved. So it does lightly overweight those. But that spread has widened. It's now over 60 percentage points gap in relative valuation between members and non-members. People will say, yeah, it's a value effect. These stocks are cheaper because they're value stocks. No, they're cheaper because they're not members. People say it's a size effect. They're cheaper because they're small cap. No, the small cap means that they're not members. Otherwise, that spread of 10 to 20% would have been wide 30 years ago, and it wasn't. So the flow of money into index funds does drive up members versus non-members, and members are mostly growth stocks. So that's played a huge role. The work that Mike has done is, I think, marvelous in one regard, and that's that he shows that if indexing gets popular enough, the market clearing price for a new member of an index could be infinity. The market clearing price of a stock that's deleted from the index could be zero, meaning that there would be no price at which there would be sufficient buyers to buy the stock. So that's a fascinating thought experiment. Where at what point do you hit that threshold where there is no market clearing price? Certainly well before the indexes are 100% of the market, but they'd have to probably be 80 or 90% of the market to have that disturbing characteristic, that deeply disruptive characteristic. But somewhere between here and there, they are disrupting more and more. Now, that doesn't mean that I advise people to shun index funds because they're doing damage to the market. No, investors care about what they're earning in returns. You've got to give them something that performs better. And that's been our focus, developing fundamental index and developing a better cap-weighted index that doesn't chase fads and bubbles are two contributions we've made to the whole narrative and to finding ways that people can earn better money while being less disruptive to the market and to the economy.
Once upon a time, there was SPY, and there were a few index funds and ETFs tracking the broad market. Now we have some 2,000 stocks ETFs in Europe, and I think something similar in the US. Every day, the popularity of new kinds of passive/systematic/fancy rule-based instruments is growing. For example, factor ETFs are very widespread now. What's your opinion about those kinds of instruments, and can they bring about a shift? Because if a lot of investors start to invest in a different way than just in index funds tracking market cap weighted indices, this problem could be somehow offset. Am I wrong?
Well, there's certainly a plethora of choices. The array of choices available to us is huge. We introduced an index for stocks that have been deleted from indexes back last June, and a company called ETF Architect launched an ETF based on that index back last September. And what a fun idea. I mean, stocks that get kicked out are by definition small cap and deep value. But unlike most small cap value companies, these are companies that have proven in the past that they know how to be big enough and successful enough to be in an index. They got kicked out because they lost their mojo. They have some of them, I like to joke, go on to achieve great failure. Others, and it doesn't take a lot of them, others regain their edge. And some of them actually rejoin the index 3 to 5 years afterwards. So that's a fun niche strategy. But when we came up with fundamental index back in 2004, a company called Towers Watson coined the expression smart beta in 2007. They realized that RAFI doesn't win because of the fundamentals. RAFI wins because of that rebalancing alpha, contra trading against market price action that isn't backed up by fundamentals doing as well or as badly as the price action, and therefore the market overreacting and snapping back. So they looked for any strategy that separated the weight in the stock from the price of the stock and had, therefore, a rebalancing alpha. They called that smart beta. Pretty soon the term was attached to anything with a formula.
Yeah, it's a kind of misleading concept.
Yeah, including performance chasing strategies, including concentrated momentum strategies. Anything that was mechanistic was called smart beta. So the smart beta revolution, I remember when I introduced fundamental index, index funds were, the people running index funds were furious that I attached the name index to a fundamentals-based strategy. And they viewed it as a threat to their business model. My reaction to them was, no, relative to cap-weighted indexes, fundamental index is a value-tilted active strategy. Relative to the economy, cap-weighted indexes are growth-tilted active strategies, kind of mirror images of one another. But I said, this is going to help your business because now people can get active strategies for much less money. If an active strategy can be distilled into a formula, there will be strategies launched based on those formulas, and people don't have to pay a percent for an active strategy. They can pay 30 or 40 basis points. And so that's smart beta is a threat to active managers, not to passive managers. And that's turned out to be the case. Passive managers have seen their growth, if anything, accelerate. And smart beta has, depending on who's doing the counting, has soaked up somewhere between $2 and $3 trillion. It's been fun to watch, but the simple fact is indexing is here to stay, is going to grow as far as the eye can see. But at some stage, that spread in valuation will get so wide. If two stocks have very different prices and similar growth rates, I mean, non-members and members of indexes have similar growth rates. Why should there be a 60, 70% spread in valuation? The higher price means a lower internal rate of return. These stocks will have a lower return than these stocks for the buy and hold investor. But if money pours into the funds and the spread widens to 80% or 100%, that boosts the return. So you have these countervailing forces, a pressure to underperform because the price is too high, and a pressure to outperform from fund flows. At some stage, those cancel and the edge of cap-weighted indexing disappears and underperformance begins. I don't know where that point is. When that happens, you get into Mike Green's disaster scenarios where the market is broken by indexing.
He made, off the record, this doomsday prediction that it takes 3 years from now before it happens.
Yeah. It's always fun to have a doomsday prediction because it gets people's attention. And sometimes, as with Nassim Taleb in the global financial crisis, your prediction is right and you're instantly famous for it. But I wouldn't put a timeline on it. I would just say it's coming. Someday, it might be 3 years, his timeline. It might be 10 years. It might be 15 years. At some point in the reasonably foreseeable future, indexing will itself create a market disruption of some considerable magnitude.
But my most important question is, can we do something about it as individual investors?
As individual investors, I would say diversify. Yeah. For individual investors, I'd say diversify. Don't put all your eggs in one basket, even the basket that owns everything, even the index fund. Diversify across multiple asset classes. Most Italians own their homes, so they already have that built-in diversification, which is great. Have money in stocks, have money in international diversification, have a little bit of money in emerging markets. They are deeply out of favor and very cheap these days and are priced to give us great forward-looking returns. I think the two mistakes that are most prevalent and most costly for investors are one, performance chasing. Nobody likes to buy what's performed badly. But anything that's a bargain got there by inflicting pain and losses to get there. Anything that's overpriced got there by creating great joy and great profit. So be wary of performance chasing. It is deeply ingrained in our psyche. Our ancestors on the African veld didn't survive by running towards a lion. Performance chasing is hardwired into the way we think, and it takes definite willpower to set it aside. The second biggest mistake is impatience. If something is cheap, and it's still cheap 2 years later, okay, it's cheap. Hang in there. Patience is, we all say patience is a virtue. Patience is a virtue that most of us don't have.
Absolutely. In this moment, it's impossible to overlook the fact that the US stock market is highly expensive. You wrote a great paper about the CAPE ratio. The paper was about naysayers, so people who believe the CAPE ratio is fundamentally flawed, it's not that useful to make predictions and to make claims about the status of the market. And you said, hey, wait a moment. You can't make predictions based on the CAPE ratio from one year to another, but you must pay attention to the level at which we are now. Is that right? Do I got it correctly?
That's exactly right. The CAPE ratio is a very mediocre predictor of one-year returns. The US has the highest CAPE ratio in the world. By the way, for your audience, CAPE ratio means cyclically adjusted price-earnings ratio. How do you cyclically adjust price-earnings ratios? You average the earnings over a 10-year span. So you take out the economic cycle. So 10-year average earnings divided into the price. So market's price today divided by 10-year average earnings gives you the CAPE ratio. There's some nuances like the past earnings you adjust for inflation, but never mind that. It's basically a 10-year PE. And it does a beautiful job of predicting 10-year returns. The correlation between the CAPE ratio and the subsequent 10-year returns is over 70%. Now, what does a 70% correlation mean? It means that if some genie gave you a crystal ball that told you exactly what the S&P would be 10 years from now, or exactly what the MSCI ACWI index would be 10 years from now, the CAPE ratio is 70% as valuable as having that crystal ball. That's pretty cool. Now, a crystal ball that tells you exactly one thing is not as useful as a crystal ball that tells you everything, but still, people would pay a lot of money for a crystal ball that told them where the S&P would be exactly 10 years from now. And the CAPE ratio is 70% as good. It is directionally correct on market direction relative to whether returns will be above or below historic norms. It's about 80 to 90% accurate on a 10-year basis, but only about 55% accurate on a 1-year basis. So the U.S. stock market is very expensive. It's nearly 3/4 of the MSCI World Index. Relative to ACWI, which includes emerging markets, it's over 2/3 of ACWI. That's crazy. The U.S. economy is not 2/3 of the world economy. The U.S. has done a very good job of encouraging innovation. The Magnificent Seven are not based in Europe or Japan. The U.S. government has stayed out of the way of private enterprise better than most governments. And that's created this juggernaut of business success, which has facilitated the valuation multiples for the U.S. soaring. But what's interesting is earnings and dividends for European stocks, and Japanese stocks, and emerging market stocks have grown handily, not quite as fast as the U.S., but close. And so the relative valuations don't make sense. I look at today's markets and do I have investments in U.S. stocks? Yes, some, very limited, all on the deep value small cap side. But most of my investments are in non-U.S. stocks.
Wow, impressive.
And in offbeat long-short strategies and things like that. So U.S. is the most expensive market in the world. That doesn't mean it won't be among the most expensive 10 years from now, but if there's mean reversion, watch out. The chances of the U.S. outperforming the rest of the world over the coming decade are very low.
As research affiliates, you have come up very recently with a new way to calculate the CAPE ratio, and it has received massive attention. In a nutshell, according to this current constituents CAPE ratio, the CC CAPE ratio, which is the name, the market is expensive, yeah it is, but not as insanely expensive as it used to be in 1999. A lot of people say, hey, we are at the same level as we were at the peak of the dot-com bubble. Would you comment on that? Because this way to calculate the CAPE is very interesting to figure out the real stuff we have to cope with.
Yeah, this is an idea that we've used internally for years. And I know that others have looked at bottom-up CAPE ratio as opposed to top-down. Top-down CAPE ratio means you take the S&P's price and divide it by the 10-year earnings of the S&P 500. Bottom-up would mean you take the aggregate market value of the S&P 500 and the trailing 10-year earnings of today's S&P 500 stocks and take that ratio. Now, if you do that, think back to the dot-com bubble. A lot of value stocks with great earnings, but out of favor and unloved, were kicked out to bring in new stocks that had price-earnings ratios of 200. And so a stock was dropped where for every $100 you invest, it had $10 of earnings, and replaced it with stocks that had 50 cents of earnings. That brings down the earnings base of the S&P and boosts the PE ratio. So when you look at the bottom-up CAPE ratio, you find that the PE ratio back at the peak of the dot-com bubble was far, far higher. I forget the exact number, but something in the 60 to 70 times earnings range relative to 10-year average earnings of the current components, the then current components of the S&P. And if you look at today's market, yes, we've been kicking out some deep value names and replacing them with frothy growth names, but much less of that has been happening this time versus the dot-com bubble. And so based on current components, the CAPE ratio isn't 38, it's somewhere in the 40s. All right, that's expensive, but it's not as frothy as the dot-com bubble. And that's the big takeaway. The dot-com bubble is still the biggest bubble in world history, or in the modern history of capital markets. You might find little niche bubbles like the tulip craze in the 1600s in Netherlands that were bigger bubbles, but much narrower.
Yeah, teeny
I
tiny.
mean, GameStop was a bigger bubble than tulips by far.
I think that one of the most fascinating concepts in finance, and I think it is the equivalent to the Sun Graal for those who try to seek the best way to invest, and it is the equity risk premium puzzle. Who gets the equity risk premium mechanism right wins the game. And you wrote another great article about it and about 9 myths about the equity risk premium. We could go through all of them, which would be an interesting episode standalone, but generally speaking, are we somehow delusional about the equity risk premium? Are our ideas far-fetched, and should we be more critical when we think about what stocks do in the long run, to quote a very famous book?
Yes. Well, actually, Jeremy Siegel's a good friend of mine. We just happen to disagree on the risk premium, but not as much as most people think. I mean, Jeremy is on record recently saying this market's very expensive. And stocks for the long run, yes, but don't expect to earn historical risk premia. It's not going to be the same. And he has the intellectual honesty to challenge his own thinking, which I think is important. But there's a fellow named Ed McQuarrie who went back and looked at the stocks for the long run data back to 1802 and actually took it all the way back to 1793. And what he found was that an investor in stocks in the 19th century would have underperformed an investor in ordinary government bonds for a century. Stocks for the long run, you can't live long enough to overcome a negative risk premium that lasts a century.
That's true. That's true.
So the whole notion of stocks for the long run is correct if you frame it as you will likely do better with stocks if you're a long-term investor. But do not make the assertion that you will do better. The trough of the global financial crisis, I reached out to Jeremy Siegel in late February, or no, it was early March of 2009. And I said,
at the
Jeremy,
very bottom of the crisis.
Yeah. I said, Jeremy, do you realize that long treasuries have beat the stock market now for the last 40 years?
Sure.
And he said, that's not possible. And then he called me back the next day and he said, you're right, but this is an anomaly. And I said, you're right, it's an anomaly, but it's a fact. Anyway, you can go long periods of time with a negative risk premium. Now, the other thing that's interesting is the term risk premium is supposed to mean expectational returns, not the historical return difference. By using the same term for the two different concepts, you wind up creating confusion. Why? Because past returns are past returns. They aren't forward returns. And yet we anchor on past returns to shape our expectations. My favorite example is the second half of the 20th century. In the second half of the 20th century, stocks beat government bonds by 800 basis points per annum for 50 years. Now, 8% per annum means you're doubling every 9 years. So stock market investors twice as wealthy as bond investor after 9 years, 4 times as wealthy after 18 years, and on the order of 50 times as wealthy after 50 years. Just stunning margin. People in the year 2000 were hugely optimistic about stock market returns, partly because stock market returns had been so brilliant. But people didn't take account of the fact that that huge return for stocks relative to bonds was strictly largely a function of the fact that the dividend yield for the stock market had fallen from 8% to 1%.
Because valuations widen.
Right. So if valuations go up 8-fold and stocks beat bonds 50-fold, that means net of the revaluation, really stocks beat bonds 6-fold, which is about 4% a year. That's still a nice incremental return, but now you're starting a new century with a 1% yield. How on earth are you going to get even a 4% incremental return? I wrote a paper in 2000, The Death of the Risk Premium. And I pointed out that risk premium is about expectational returns. And when TIPS, government inflation index bonds, yield 4% and stocks yield 1%, stocks have to have real earnings growth of 3% a year just to keep up with TIPS. So I said an investment in TIPS will beat an investment in stocks for the long-term investor over the coming 10 years, over the coming 20 years. And in fact, that was the case. If you'd bought 30-year TIPS back then, you're still ahead. Even now, you're still ahead of the S&P. So the notion of a risk premium should be forward-looking and should be based on what you can reasonably expect given today's yields. Today's yields in the U.S. stock market are back down to just a little over 1%. I think they're 1.3. That's not a great yield. You can get 2.5% to 3% on World ex-US. You can get 3.5% to 4% on emerging markets. You can get 4.5% to 5% on emerging markets value stocks, which strip out the frothy tech companies in the emerging markets. We have the FANG stocks, they have the BAT stocks. Okay, well, take those stocks out of the picture and you can get close to a 5% dividend yield on emerging markets value. So I look at the world today as an opportunity-rich environment where there's lots of attractive things to invest in. They just don't happen to include U.S. growth or most developed world bonds, where the yields are still not terribly interesting.
In your opinion, I think they know the answer in advance, but for the sake of the conversation, do buybacks play a role in this situation? I mean, the dividend yield has diminished over time in the US market, but conversely, buybacks have grown. Warren Buffett famously said that he only paid dividends in the 60s, but he should have been in the bathroom when the board of directors decided it at Berkshire. So he is a huge fan of buybacks, and indeed most of the companies in the US started to do more buybacks than paying dividends. Can buybacks offset this effect, or are they two completely different things?
The short answer is yes and yes. Buybacks, the myth on buybacks is that the dividend yield plus the buyback yield is a combined effective yield for a stock. So if a company pays 1% dividends and then buys back 3% of its outstanding stock, there are those who say, well, the effective dividend yield is 4%. That is absolutely not true. From the vantage point of the shareholder, you are receiving 1%. The other 3% you only receive if you're no longer a shareholder, if you sell the stock in the buyback. So for the ongoing shareholder, you only get the dividend. And the only way that 3% buyback helps you is if the buyback leads to an acceleration of earnings growth. That acceleration of earnings growth is a possibility if the buyback costs the company less than its reinvestment opportunities within the business. And of course, every business thinks their reinvestment opportunities are big relative to the cost of capital, but they're often wrong. So the buybacks cost the company just as much money as a dividend. That's 1% yield plus 3% buybacks. The company's spending 4%. The shareholder is receiving 1%, unless they sell and are no longer a shareholder. So the myth is that you can add the two and treat it as a dividend yield. It's not. The buybacks can be beneficial to the ongoing shareholder if the cost of capital is less than the earnings the company will make on redeploying that money internally, which is often the case if cost of capital is low enough. So we saw buybacks surge in the mid-2000s. What happened in the mid-2000s? We had very low interest rates coming out of, in the mid-2000s, interest rates dipped sharply to the 1% to 2% range. Then they rose again before the global financial crisis, and buybacks stopped. Then, after the global financial crisis, we had a decade of truly unprecedented negative real yields globally. It was just wild, and negative nominal yields for that matter. Well, if you can borrow money for zero, do the buyback. You're going to benefit the shareholders. You're going to benefit management on their stock option redemptions. It's a win-win all around. But with interest rates rising again in the last 2-3 years, buybacks are slowing because the money's not free anymore. So buybacks are not correctly well understood. There's even some towering world-famous academics who've made the claim that you can add the dividend yield and the buyback yield, and that's what the investors are getting. No, it is not what the investors are getting. The investors are getting the dividend yield and maybe a step up in growth due to the buyback, but that's iffy and by no means assured.
Robert, last question, though I would stay here for hours. In 2024, the Journal of Portfolio Management, which is one of the most important journals in finance, turned 50. According to your very long experience as both researcher and editor of the Journal of Portfolio Management and as investor, are there timeless truths that never change in investing that could be practical long-term advice for people listening to us?
I'd come back to the two biggest mistakes people make. Performance chasing. Watch your instincts. You will find that when somebody's bragging about their wonderful investment, you're tempted to say, oh, I need to buy that. Bitcoin crosses 100,000. Oh, I need to buy that. Beware of envy creating performance chasing. Beware of hidden performance chasing. When a quant firm like our company, we do back tests. The quant community is addicted to back tests to test their ideas, which is fair. But then they go a step further. They use the back test to improve the back test. Now that's naughty. that creates a better backtest and often creates a worse product. So beware of backtests that are used to improve the backtest as a hidden form of performance chasing. Quants like to say we are objective, we use facts, and we don't use emotions, so we don't chase performance. That's bunk. Quants do chase performance in an unintended, indirect way. And the second thing is patience. When you're investing, to borrow from Jeremy Siegel's title, you're investing for the long run. So think about things for the long run. Ask the question, is this company's business going to be awesome this year and next, or is it going to be awesome for 10 years or 20 years? Ask the question, where are the hidden gems where a 10-year or 20-year horizon can have high odds of rewards? And today I will look at small cap value all over the world as the big unloved opportunity, and unloved partly because cap-weighted indexing has created that valuation spread that, if you look at large growth versus small value, is the widest spread ever.
Robert, thank you so much for this very insightful discussion. It was a true privilege to have you here.
This was great fun. Thank you very much.
Bye-bye.
Bye.
And that's all, folks. As always, I hope you enjoyed this episode and found it valuable, as a moment where one of the most authoritative voices in global finance shared his insights with us, shaped by decades of theoretical research and hands-on experience on the world's most important financial stage. I can only publicly thank Robert Arnott for the privilege of joining us today, and once again, I want to thank you, all of you, who for hundreds of hours have chosen to dedicate your time to listening to what I have to say. My hope is that moments like today's will continue to reward the trust you have placed in this podcast. To keep our journey going together, I invite you to hit follow and turn on notifications on Spotify, Apple Podcasts, or wherever you listen, and to leave a 5-star review to support us and help us continue producing contents that bring you the greatest legends in finance. For this episode, that's really all, and I'll see you again next Wednesday for another session where we'll talk about portfolios, investments, and most importantly, the key takeaways we can draw from this unique moment in time. Always here, of course, on The Bull, your personal finance podcast.